Ask me what I'm doing, just grinding. Haters wanna hate, let them hate, never mind them. Be more bins, tryna reach the next plateau. And I can't stop till I achieve my goals. Keep a couple fees inside the photos. So official with the vibe, you can't fuck up my zone. Hold on for a minute, let me count mine, you know.
Welcome to the Ultimate Wealth Podcast, the show where we unlock the secrets to financial empowerment and lasting prosperity. I'm your host, Derek Pasalacqua, and together we're on a journey to transform your financial future and elevate your life to new heights. Join us each week as we dive deep into proven strategies, powerful insights, and transformative stories. Whether you're an entrepreneur, a busy professional, or someone seeking to create wealth and build a lasting legacy, this podcast is your go-to resource for achieving financial mastery and living a life of intentional greatness. This show is about more than just building wealth. It's about creating the life you deserve. So join us and let's build a future where financial freedom is not just a dream, but a reality. Welcome to Ultimate Wealth. Hello and welcome. This is Ultimate Wealth. I'm your host, Derek Pasalacqua, and today we're going to dive into the topic of whole life insurance and the many uses of whole life and all the utility that it has, and why we prefer to use whole life as compared to maybe like something along the lines of like an IUL or term insurance. First, I want to just start off by just jump right into it. And let's start off by talking about what makes whole life insurance different than maybe a term policy or universal life policy or index universal life, either one. So one of the biggest differences right out of the gate is just simply the fact that whole life insurance has fixed cost. So at the onset of a policy, when you are very first getting a policy put in place and you go through underwriting at whatever health you're at and age you're at, okay, when that policy starts, when you make your first premium payment and it becomes effective, that the cost is set. The cost of insurance right then in whole life insurance is a set fixed cost, because they're just determining at that point based on the actuarial data that they have. They're making a prediction for what the odds are of you living whatever X amount of time, and then they're setting based on your current health conditions and your current age and the data that they have from kind of the law of large numbers, how they try to spread risk over a great area as possible to minimize the damages. They're going to set you with a number, a cost, and that cost is going to be fixed, set, cannot change, will not increase, won't decrease. It just is what it is. With term insurance, you will have that for a set amount of time, maybe 10, 15, 20, even 30 years. But once that fixed period is up, then premiums are going to increase dramatically, especially towards the later years of your life. Now, premiums may not get that crazy if you do a 10-year term from age 20 to 30, or even age 30 to 40, or even a 20-year term from age 20 to age 40. You'll see a little bump, but it won't be like insane. But you do a 20-year term from age 40 to age 60, come age 61, you're going to see a pretty noticeable bump. If you try to do another 20-year term, it's going to be considerably more expensive than it was before. Okay. Now, with Indexed Universal Life, IUL, which is super, super popular nowadays, and it's what all over the place. If you can't hardly get on TikTok, YouTube, social media in general, without seeing someone talking about IUL or trying to sell you on how amazing and awesome it is, and how you should cash out and cancel your 401k or your IRA and throw all of your money into an IUL policy. But before you cash out the 401k, let's maybe take just a moment. Before you cash out your 401k, let's maybe take just a moment and look at our options, and let's maybe think this through a little bit first. So while an IUL, I'm not going to ever sit here and say like just cannot work. I'll I'm never going to say that. They absolutely could work. But the way I view insurance is hedge risk and eliminate risk, or transfer risk rather. So why would I assume extra risk when I don't need to or have to? Right. And that's kind of where I stand with it. So sure, you maybe have a little bit, tiny bit more upside potential with an IUL versus whole life. You also have increasing cost every year because it's built on the chassis, universal life chassis, which basically essentially it's annually renewable term insurance. So there's that. So your cost is going to get increased more and more each year. Now, if you overfund it enough and you can drive the net amount at risk and basically drive that cost down in later years. But the second that you start borrowing from it in retirement, and then you have one or two down years, and or God forbid you've had to underfund it at all, during any point in early years, then it's just, in my personal opinion, there's just too many chances for something to go wrong. In a perfect world, maybe they're great. Life doesn't exist on a spreadsheet. One of my favorite sayings I heard a long time ago, and it's so true. And I think you should be cautious of betting the house on a strategy that really depends on the stars perfectly aligning every single time. Because in my experience, that's just not how life's going to unfold. Usually it's going to kick you in the teeth and slap you around a little bit. And typically it's when you least expect it and when you can least afford for it to happen. So why expose yourself to unnecessary risk? Especially with something as important as life insurance, and if you're using it for income and retirement, I think it's great as a volatility buffer. I think because it enhances your other investments in the market. You can allow them to kind of recover from a down year or two and not have to freak out and worry about running out of money, and because you don't have to draw down on those accounts during down years. So for that, it's great, but I still think, in my opinion, whole life is much, much better just because of the control it gives you. And I don't just mean control in the controlled and the fixed cost, but I mean control in like every single aspect of life. So it allows you to control everything else in your life that much better, from your 401k or IRA or just your market investments. It allows you to control those much better. It allows you to control your cost of capital much better, simply because you kind of get to choose whether you want to borrow from the insurance carrier or whether you want to borrow from the bank based on what current interest rate environment looks like. So you have all these options, and in most scenarios, most cases, I would say that more options is a better thing, unless we're talking about IUL, because they buy call options. And in that case, I would disagree. But the stupid jokes aside, I think, typically speaking, if with the more options we can give ourselves, the better off we are, because we're kind of more better prepared for the different situations that can kind of come about in life. So if something hits us, it's just kind of like when you're selling something and somebody gives you an objection. The more rebuttals to that you have kind of in your up your sleeve or in your bag of tricks, the better equipped and prepared you are to handle that objection and to overcome it, because you have 3 or 4 different ways to go about it, and you're not just limited to just one way. And that's kind of what IUL does, is it really limits you to, this is the one thing, the stars have to perfectly align and for this one route to open up. And when it does, it's going to be great. But if everything doesn't work out perfectly, it's never going to happen. So as long as you're well informed about the risks associated, then go ahead, make your own decisions by all means. Me personally, I'm not a huge fan. I don't think it's a bad product. I think it does what it was designed to do. I just don't think it was designed to do what it's being sold as, if that makes sense. And there's a lot of moving pieces, and it's trying to be sold as a super overly simplistic solution to a very complicated kind of problem and circumstances that people are facing here. So, anyways, so now when we talk about whole life insurance, we don't talk about using it in the traditional sense like most folks do. So we're talking about properly designed and used for infinite banking typically purposes. So what exactly is infinite banking? Well, infinite banking is nothing more than a concept, idea of how to use your money kind of more efficiently. And like I've said, you've heard me say before, if you've listened to any episodes in the past, but Nelson talks about in the book, Becoming Your Own Banker, he says, the first thing that you have to understand when you start practicing this concept is that we finance everything we buy. We either pay interest to someone else or we give up our ability to earn it. And when you can make that paradigm shift, and it took me a minute, but it really, when it clicked finally, that's kind of what changed everything for me. It's like I'd never stopped to consider the fact that whenever I went to the store and spent $1, that I didn't just lose that dollar, but I lost that dollar and everything that it could have earned me for the rest of my life. And that's what opportunity cost is. So, and everything has opportunity cost. And there is no magic bullet to get around it. You're going to pay it. It's just a matter of how can we minimize it. And I believe that's what infinite banking really does a very good job at, is minimizing that opportunity cost. And that's another reason that I love, instead of listening to people, constantly talk about average rates of return, especially when they're talking about the stock market, mutual funds, and the, big returns that they've had, 12%, 10%, whatever, average rates of return over the last however many years. To me, that really doesn't mean a lot, because I just think average rates of return are kind of silly and deceptive. But because you can have in one of my previous episodes, I just talked about how you can have this crazy high average rate of return of 50% or better, but still lose money. I mean, I think I did one example where the average rate of return was 125%, yet the account value went down 25%. So if average rate of return was such a great way to measure an investment's performance, then I just think it would be not so deceptive. But so what I like to look at instead is what's called an IRR, an internal rate of return. Internal rate of return automatically factors in opportunity cost because it looks at cash on cash. So money in versus money out, right? So money out of your pocket that goes into whatever it is versus the money that it returns to you. So the money out of your pocket versus the money into your pocket. So it's literally, so what is my return based on my time and my dollars allocated? What am I getting back? And so it allows you to compare two kind of investments that are different and that even have different cash flows. You can still compare them because you can see which one is giving you the higher return for your effort, for your dollars. And so I just think it's a much more accurate way to look at things, and a much more accurate measuring stick, if you will, for looking at any type of financial product or investment scenario. So getting back to whole life and kind of some of the reasons we really like it and prefer it over, any other type of insurance is, and you hear us talk about all these amazing benefits all the time. So I just wanted to take today to kind of go down and really just identify what some of these are, and then really kind of break down what we mean when we talk about all these amazing benefits, because I feel like, when we just say that as a blanket statement, we're no better than, anybody else that says stuff. And then we want to come try to attack it because they didn't take the time to explain it. So instead of, continuously being a hypocrite, I'm going to try to break down at least a little bit of what we mean when we say all these benefits and features that you get. So number one, well, I forget, I'm not going to go in any sort of an order. I'm just going to kind of talk about them as they come to me. But I would say the very first one, like I said before, though, is the fact that the paid up, that you have a fixed cost and it can be paid up. You can never pay up. You can pay up term, I suppose, because it's for a set period of time, but you could never pay up an IUL. IULs can never be paid up. So there's that. And you can stop making payments, but that doesn't mean it's paid up. So I just want to be clear on that. Which leads me right into the next one, which is guarantees. You get guarantees that allow you to make more sound financial decisions with whole life that you just can't with other vehicles. The fixed costs and the guarantees are really, I feel like they're kind of undervalued, honestly. And then you also get, obviously, a tax-free place to store and control capital, right? So it's a savings alternative. So, if you're looking at apples to apples comparison, you have to compare it to a savings account, and because that's what it is. It's a savings alternative, a place where we store our extra cash above and beyond what we have set aside for emergency fund typically. And so when you look at it from that perspective, it's going to give you uninterrupted lifetime compounding growth at a guaranteed interest rate or a declared dividend, which technically the dividend becomes the guarantee the moment that the insurance carrier declares the dividend. It is now the guarantee the second they declare it. And people try to argue all the time the fact that you have to pay to borrow your own money. So let me address that quick. Number one, you're not paying, you're not paying to borrow your own money. You're borrowing the insurance carrier's money. Your money is still in your account, continuing to grow, continuing to compound as if you never touched it because you never did. Number two, yes, you're not paying yourself interest. You're paying the insurance carrier interest. Could you pay back yourself extra money that would go towards paying yourself interest? Sure, whatever. But I mean, you could also just pay yourself extra money. I mean, that's kind of silly to me. You're paying the insurance carrier back with interest. Now, it does work like a line of credit where every time you make a payment, they credit that back to you. That amount is then credited, available to borrow again. So it does work that way, yes. But you're not paying yourself interest. You're not recapturing interest. You're paying back the insurance carrier with interest, period. Okay, that's number one. Or number two. And then also, so you're not borrowing your own money. Number one, you're not paying yourself interest. Number two, you're paying them interest. But number three, let me tell you why that's not a bad thing. Because remember, when you're at a participating mutually owned company with a participating whole life policy that gets dividends, you are a part owner of that company. You share in the profits. That's what a dividend is. It is a share of the company's profits. What is an interest rate? It is a way for a company to make money. So when you're paying them an interest rate and you're continuing to get that uninterrupted growth inside your policy, and then they share that interest, that profit back to you through a dividend from the interest that you paid on the loan and every other policyholder paid. I'm not saying you're going to make all your money in interest back, but I'm just saying that if you share in the profits and that interest you pay to them is how they make a profit, then you're going to get some of that back. So that's minimizing it. And plus, like I said, the best part is you're continuously compounding in the right direction. And money's always going to compound forward faster than compounding against. So especially even if you're just making the interest payments on that on your loan with the carrier. And that so leads me right into my next point, which is when I talked about having more control previously, you also have more control with your costs, not just of the policy, but of your cost of borrowing money. So during high interest rate environments, you can use the carrier, and you have that fixed cost. It allows you to control. Like right now, I think it's 5%. Or when a lower interest rate environment, like we were in a few years ago, instead of using a carrier, you can take your policy to a bank and you can leverage it to get money at a much lower interest rate, maybe 1 or 2%. And the other thing is, like, say you have terrible credit, when you borrow from the carrier, it doesn't matter. You don't need good credit. There's no application process. There's also no contribution limits. You can open as many policies as you need to. There's no penalties, no fees for early withdrawal. There's no limits on age. Credit doesn't matter. There's no application process, approval process, rather, to get your access to the funds. So you have quite a bit of a lot of benefits, and you have the guarantees. You also have the dividend because you are part owner of the company, like we said before. And when you have that dividend reinvested to buy paid up additions, that increases your death benefit every year. And to the people that say that with whole life, when you die, they keep your cash value. Sure, they keep your cash value, but your death benefit is increasing each year by more than your cash value. So it's kind of already built into it. I mean, if you had a couple million death benefit or a few 100,000 in cash value, which one would you rather your family get? It's kind of silly, stupid argument. And so you have that increasing death benefit. In certain instances, you can even, when you borrow against your policy and you make your payments back, the interest to the insurance carrier can even be tax deductible when it's for business uses, which is kind of nice. But I would encourage you again, none of this is financial advice. So for the love of God, don't sue me. And this is all just for educational and entertainment purposes only. Just be clear about that. And always consult your own insurance agent, legal counsel, attorney, whatever you need to before making any financial decisions. So, but I think what whole life is most popular, most famous for is you get to tax-free, a lot of people call it tax-free growth. It's technically tax-deferred growth, but it's tax-free access, and then you pass it on tax-free as well. It's one of the most efficient ways to pass on, wealth to the next generation. And then lastly, I'll just touch on the fact that the living benefits part. Okay, so a lot of these come with living benefits as well. And when I say living benefits, I'm referring to the critical, chronic, and terminal illness riders. All right, and so if any point you lose the ability to do 2 of the 6 daily living activities, you're able to actually accelerate a portion of that death benefit while you're still living, which could essentially, I've heard of firsthand seen scenarios where that's been able to save someone's life. Someone I know got a cancer diagnosis, was able to accelerate their benefits, and are still alive to this day because of it. So they can be extremely powerful, and I think they're one of the most underrated aspects that you don't hear people talk enough about. One of the greatest fears of the baby boomers and the older generations is the long-term care, and how long-term care is expensive if you're trying to buy coverage, and this can be not necessarily a replacement for it, but it can be a really good alternative to kind of help supplement and cushion and just kind of guard against some of that a little bit without having to pay the outrageous cost of long-term care insurance, because a lot of people just simply can't afford it. But I think you hear a lot of people talk about the uninterrupted compound growth of the policy. And while that's great, to me, that's not what's most important to me. It's simply just the fact that it gives you all this other utility. It works as the volatility buffer in retirement. It allows you to have more options. It allows you to have controlled cost of your money. It allows you to have controlled cost and just control in general in other areas of your life. It allows you to show up more powerfully because you have something that is set, something that is fixed, something that does not fluctuate, something that gets more efficient over time, something that you can count on and rely on, and your family can rely on to be there no matter what. And it can ensure that the things that you want to happen in this life and the things that you value and what matters to you and the things you care about, you're passionate about, your family care about, that ensures that those things can happen no matter whether you're here or not. That it's the guarantee, the backstop that promises that it's a unilateral contract between you and that carrier that says, hey, as long as you make these premium payments, we're going to be there when your family needs us, and we're going to take care of them, and we've got them with this payment. And they don't need to worry or stress out, and there is no replacement for that, period. If you want to learn more about whole life insurance or infinite banking, how you can use this concept in your life, come check us out at ultimatewealth.mvt.so. Again, that is ultimatewealth.mvt, Michael Victor Ted.so, Sam Octopus, or you can go visit our website at www.ultimateacceleratorblueprint.com or mydebtfreeadvantage.com. I'm your host, Derek Pasalacqua, and this has been another episode of Ultimate Wealth. I hope you have a great rest of your day. Thanks for joining me and staying with me to the end today. And as always, remember, live your legacy.